Welcome to the SNN.Network Canada virtual event. I'd like to introduce our next presenter, Gaston Halazon, CEO of EMERGE Commerce. Sir, the floor is yours.
Thank you very much, and good to be here with everyone. Appreciate your time here this afternoon. My name is Gaston Halazon. I am the founder and CEO of EMERGE Commerce. TSXV ECOM, we're a publicly listed company here in Toronto on the Venture Exchange. And what we do is we are basically a buyer and builder of e-commerce brands, really niche e-commerce brands across North America. We view ourselves as one of the rising premium digital brand portfolios. And really what we've amassed is a sort of hidden gem niche e-commerce portfolio that's scaling rapidly, diversified, and is starting to show real profitability. Overall, to give you an idea, we have about 120 million plus in gross merchandise sales, essentially sales processed across our platform. We have about 8 brands, 5 verticals, and obviously across Canada and the U.S. On a revenue basis, that's about $60 million in Canadian dollars, that is, of IFRS or GAAP style revenue, and about $7.4 million on a pro forma basis of adjusted EBITDA. We really do pride ourselves on our disciplined capital allocation approach. We tend to acquire businesses cost effectively at fair prices, normally 4 to 6 times EBITDA. We integrate these businesses under a universal shared network and platform where they essentially gain from the benefits of the scale we provide that is unavailable to any individual portfolio company on its own. And then ultimately we help them leverage each other's knowledge, their network effects, their data, their cross-selling opportunities, and just make these brands better than they were on their own. Today we have about 5 verticals. Those are experiences, golf, meat, outdoor gear, and pets. And we're going to be looking at our most recent acquisition, which was the wholesale pet acquisition here shortly, to give you an idea of the types of hidden gems in e-commerce that we are amassing under our portfolio. So if you get a sense here, basically we're looking at a B2B marketplace, one of the leading businesses in pets overall, but the number one wholesale solution for vendors and retailers to plug in and purchase and sell from each other. So we have about 8,000 retail locations on the platform. They plug into wholesalepet.com and purchase up to 1 million SKUs or 1 million products from about 400 vendors. So these are things like toys, apparel, treats, and it's a business that, given the flywheel of having all of these vendors and retailers already shopping on there and transacting, the business commands very minimal marketing budget. And so it's actually a very unique e-commerce business in the sense that the marketing dollars are really low. There's no need to attract customers. This thing is scaling and has been for 20 years now. So a highly diversified platform, asset light, no inventory risk. The business has moved over $250 million worth of gross sales over that 20-year period, with about $40 million in this latest 12-month period, as you can see on the top right. So it's a business that has significant scale, is already profitable with $2.8 million in EBITDA, and you know, there are a number of things we like about it, and we view this as sort of a starting point in the overall pet vertical, which is obviously, as many of you can imagine, the pandemic has been huge for e-commerce at large, but even more so for the pet industry going online, and we view this as an anchor asset into all of that. Here's a very impressive view of the last 20 years. You rarely get to see this with technology or e-commerce companies, mostly because most of them have not been here for anywhere near 20 years. But you get to see a picture forming here with incredible consistency and reliability through the financial recession. Obviously, the pandemic was a net boon for pets and e-commerce, but you know, just that track record of 22% CAGR, continuously cash flowing and profitable, veteran team that joins us under Chris Avery's leadership. He was a decade-long executive at Lowe's companies, and Bo Nelson, the actual founder of Wholesale Pet. Here's a pro forma view of the business. We had EMERGE with all of our other 7 brands combining for 70 million plus in GMS, about 55 million in revenue, and 3.9 million in adjusted EBITDA. And that's inclusive of the most recent acquisition we made with BattleBox, which is a camping and hiking subscription box, a very profitable one. So add wholesale pet here, and the emerging picture is one that gives us, scale beyond the 100 million mark. So we eclipse that, almost 60 million in revenue, and adjusted EBITDA of 7.4 million. And so you get to see sort of those benefits. Every time we're adding a company, we're sharing our HQ costs amongst a bigger base. We're sharing our public costs amongst a bigger base. And, of course, we're diversifying our revenue, which comes in handy, especially in today's unpredictable macro circumstances. So let's take a deeper dive into acquisitions and our M&A strategy overall. So as you can see, being an acquisitive company, it's important to set these parameters early and to really follow through and remain disciplined along the way. With EMERGE, what we focus on, the sweet spot for us is those sort of $1 to $5 million EBITDA businesses per acquisition. Normally, we've been able to secure them at around 4 to 6 times. In fact, the wholesale pet acquisition comes in at about 5 times in the upfront, and then all in with earn-out 6 times. You want to see that good, healthy, double-digit organic growth. And as we've said, sort of that niche space is what we're after. We're not looking to play when you think of Amazon, for example, that's what we call the everything store, right? It's an all things to all people store. We're not really going after that big boy type game. We're really zooming in on those smaller niches that are very profitable and can be $100 million plus opportunities, but we're not looking at $1 trillion mass opportunity for all things to all people, because we think that's highly competitive and frankly highly expensive to build. If you look at sort of our mix, typically, you are looking at sort of cash and a mix of shares and earnout. With wholesale pet, for example, almost 50% was upfront. The remainder was in mostly earnout and a bit of shares, about 3 million in shares out of the 25 million consideration. So it was about 12 million upfront, and then another 3 in shares, and then 9 in earnout, and a couple in deferred. So overall, we tend to structure these things with great discipline, and we tie them to a minimum revenue and EBITDA targets. Here's a bit of a view on our M&A pipeline. And, if you tuned into my summer presentation here at SNN, there was this sort of slide, and we had not yet checked these boxes. But the point being here, we have multiple signed LOIs at any given time, and we've made a name for ourselves, under-promising and over-delivering, and really following through with these acquisitions. And so from our perspective right now, you're looking at 2 businesses that we've acquired here in the last month and a half. We closed BattleBox in October, and then in November we closed Wholesale Pet. And they combined for $78 million in total top line and about $7 million in EBITDA. So we are now rapidly scaling M&A. We have the infrastructure and the team in place to do it. The investments we've made all year since going public, and by the way, for those of you who don't know, we went public back in December of last year, so we're just coming up on 1 year. And we're basically at the point now where we're about 1 acquisition, maybe 2 if we end up doing, a tuck-in, from $100 million in actual revenue and $10 million in EBITDA on an adjusted basis. And we really think that's a hugely important number. Maybe it's a bit symbolic, nice round numbers, as you know, but those are numbers that I think will get us a lot of attention from the institutional investors in particular that we're looking to, sort of bring on board and build out that next layer of long-term investors. As you can see, the categories that we're zooming in on include wellness and beauty, e-bikes, smart home, and of course we're already in golf, but we see some opportunities there. And you'll notice, a lot of even if we say we're focused on 1 to 5 million in EBITDA, we're really sort of starting to graduate to 3s and 4s and 5 million EBITDA levels, and even over time that'll also increase. We have one here we're showing that has $12 million in EBITDA from the smart home category. So you might ask, for those of you who don't know, sort of what do we do with regards to some of these acquisitions, and sort of from our perspective, you're looking at shared services for all of our e-commerce companies. So these small bootstrap businesses often don't have enough resources or time or expertise, frankly, to go in and get the best prices and integrate everything in a seamless manner. And so what we've done is we offer our portfolio companies a one-stop shop. Think of it as the pipes that drive e-commerce forward, right? So in other words, if we were a shopping mall, an offline mall, actually, and we had all these stores, imagine us telling these stores, guys, don't worry about security services or air conditioning. We're going to handle this for the whole mall. It wouldn't make sense for each of them to figure out their own security structure and their own AC and so forth, right? So that's exactly what we're doing for online companies. We're telling them, don't worry about how secure your site is, or how your hosting works, or how you send your emails, or deal with BI, like business intelligence. Like, we're going to be dealing with a lot of that. And you can focus on conquering golf and so forth. We're a one-stop shop. We're going to save you time and money. So a bit about sort of the other side of this is, as I said, we acquire companies cost effectively. We do it with great capital allocation discipline. We then integrate these businesses on a single platform and sort of playbook. But then we also accelerate them by helping them collaborate, cross-sell, giving them our M&A expertise to tuck in acquisitions, thinking through data strategy and a data hub that's shared universally, right? So these are all different ways we add value. So a quick sort of update, and again, some really nice numbers we're able to share here. We just came out with an announcement yesterday, and it was followed up by a Raymond James research update today on EMERGE. We really sort of had this very special November, and Q4 to date, we're on a calendar year, by the way, but Q4 to date has been phenomenal. But here are a couple of quick highlights from November. We saw with the wholesale pet acquisition, we eclipsed the 100 million mark, now on a 120 million run rate. We had our first ever $1 million day in gross sales, which is, I think, very exciting. It was on Cyber Monday, which is normally one of the biggest days of the year. But, for us to start reaching those levels is super exciting for the team and for the future of the business, as well as potential acquisition targets, seeing that we are a portfolio that is scaling rapidly, and we're doing it profitably. And so yesterday's announcement included also the fact that November 2021 was our first $10 million month. So we thought that was incredibly exciting, and the timing of it couldn't be better heading into 2022 here. So Q4 is really that first glimpse of the power of our pro forma platform, after having spent a lot of time all year investing and acquiring and putting things together. So that is the essence of the result here is again, a business that is basically 4 times the size it was about a year ago on a sales basis, and almost 9 times the adjusted EBITDA that we saw in 2020. A couple of other highlights that we share: wholesale pet in its first month is seeing double-digit organic growth, very strong profitability, and importantly, cash flows. BattlBox had a great initial month in October when they joined, over $2 million in gross sales and a repeat customer rate of 85%. trulocal, our subscription box for meat, remains at 2 times pre-pandemic levels. Same thing with JustGolfStuff, also seeing tremendous lift even versus last year. So just to touch on sort of the team and briefly the cap table. So essentially, we've really amassed a management team that has real depth and bench strength in terms of all the key areas we touch, those being e-commerce, technology, M&A, and capital market. So our executives have all sorts of either been a part of or are on the way to scaling a multi-billion-dollar organization. And some of these companies, our head of M&A is from Dye & Durham, which is a big Canadian success story, about $3.5 billion market cap in consolidating legal software companies. We added John Kim from Well Health, also $1 billion health tech roll-up here in Canada. Our CFO Jonathan Leon comes from Vet Strategy, also $1 billion roll-up in veterinary clinics. So there's quite a bit of background there. Obviously, myself, I haven't touched on yet, but I've done e-commerce for about 12 years now. I've basically amassed a PhD in acquiring, selling, restructuring, buying e-commerce companies and really bootstrapping them and partnering with founders at various levels and cycles. So I think we put that all together and really sort of have even a broader network of board members and advisors all around these themes that have really positioned EMERGE really well as we start to think through the road from the 100 million mark to the billion mark here in the coming years. From a cap table perspective, important to point out, insiders own north of 30% of the overall share structure. Board and management, we've never sold a single share since going public. In fact, this past week it was reported that management and certain board members were buyers of EMERGE stock, including myself and the executive team. We view this as sort of a very compelling entry point. We've built a lot of value in terms of sales and ultimately EBITDA pro forma. We don't think that's been reflected in the stock so far, and we think there's a tremendous ability now to go out and really build on this execution on the business side and ultimately have it translate to the share side. And speaking of the shares, this is sort of, we don't give our own guidance, but we do share the consensus estimates here out from Canaccord, Genuity, and Raymond James. They both have been covering our company since March of last year, of 2021 rather, earlier this year. But as you'll see, this is sort of their view and some historicals as well. EMERGE grew revenues from about $4 million in 2019, here in the lower left, to about $9 million, so almost double that. We doubled in 2020, and we're expected to grow from $9 million to about $34 million this year to $65 million next year. And this is excluding any additional acquisitions, just to clarify. In terms of our EBITDA, as you can see in 2020, it was our first adjusted EBITDA positive year. And this year we're looking at around $1 million or thereabouts, with next year being a huge year given all the investments we've made. The expectation on us is almost $7 million in EBITDA, inclusive of all of our corporate and public costs. So mega year expected, mega scale up, inclusive of all the progress we've made. We're excited to prove the thesis out. And by the way, consensus price from both of these firms, Canaccord and Raymond James, is $1.72 versus a share price in and around the 66 cents right now. And really, I just wanted to share, in summary, sort of this view of a diversified, rapidly growing, profitable e-commerce consolidation play here. We look at the Berkshire Hathaways of the world, we look at the Constellation Softwares of the world, and we envision a world where EMERGE starts being that for digital brands, but doing it incredibly carefully, keeping up and focusing our priorities on cash flows and on a collaboration between these companies in an accretive manner. And we think this at scale is a multi-billion-dollar opportunity. There's one last slide I actually wanted to share that I think you will find valuable, and that is the summation of sort of where we are from a valuation perspective. We bucketed some of the e-commerce giants out there in one bucket with ECOM and marketplace companies, the usual suspects, Amazon, Shopify, etc. We have another bucket with the direct-to-consumer or D2C e-commerce companies like HelloFresh and Warby Parker, and then some of these consolidators that are well known here in Canada, like Constellation Software and Well Health. What you'll notice is that EMERGE is highly undervalued relative to any bucket. And so while we're trading at 1.5 times revenue right now, whether now or over the next couple of years, you're looking at peers ranging on the low end at 4 times revenue all the way up to 15 times revenue. And so we think there's a discrepancy not only on the revenue side, but even on a profitability perspective. Pro forma EBITDA has us at 10 to 11 times versus our peers, many of which are not profitable, by the way. But a lot of our peers up here on the low end, you're looking at, next year's multiples 26 times, and on the high end, 120 times. It's 121 times. That's crazy valuations out there. We're not saying we're worth 100 times EBITDA or anything silly like that, but we are saying that we're worth more than 10 to 11 times, right? And so if you buy that EMERGE at scale as we continue to acquire, will turn into a 20 times or 25 times EBITDA multiple. Now you're talking, $2 to $250 on a share base. We have about 100 million shares outstanding. And if you take 10 million EBITDA, which is what we'll arrive at after this acquisition, now you're looking at, $200 million or essentially, $2. And again, we're not here to debate or predict what share price will be, but the thesis here, the importance of what I'm saying is, we are, in our view, undervalued, and we believe our share price is detached. And thus lies the opportunity for any value investors out there that recognize we execute, we underpromise and overdeliver. The research out there is compelling. And from our perspective, we have the right team at the right time, at the right place, in the right industry that's growing very rapidly to make some big moves in a $4 trillion e-commerce world. What's another $1 billion or two? And we think that we're going to be one of the groups out there to continue to scale up to very special levels. Now that we've done, $1 million a day on Cyber Monday and $10 million in a single month, these are starting to get exciting. And of course, most importantly, we're coming at it with an EBITDA lens and with a cash flow positive lens in 2022. Thank you for listening. That's all we had for the prepared portion of the presentation. I'm going to open it up now for Q&A, and I see we do have a couple of questions here that I will be addressing for the audience. So the first question is, what is your vision for the company in the next 12 months? Where would you like to be? Thanks for the question. From our perspective, the easiest way to say it is this year we went on a pretty big shopping spree. We acquired 4 brands through these 3 acquisitions, and we've scaled up the business significantly. So I think for 2022, number one on the agenda operationally is making sure we extract the synergies that we are capable of and that we see in each of these acquisitions and together. So I think synergies is a big aspect. The second aspect is tuck-in acquisitions. So we now have 5 verticals. We think each of these verticals could be strengthened with additional smaller acquisitions that are synergistic as well. So that's number 2. Number 3, we continue to open our eyes to new areas and new verticals. As a diversified portfolio, we don't want to self-select out of any new vertical as long as it exhibits sticky organic growth and profitability metrics. We are open to looking at areas within that vertical. And then lastly, when we think through all the business progress we're making, right, we want to make sure that ultimately translates to share price, which we don't believe it has so far. And a big part of that is getting the awareness out, which is why we're starting to do conferences like this one at SNN. And you guys have been great here. But we're also starting to think through bringing on more eyeballs in terms of research, in terms of institutional investors, in terms of, we're thinking through uplisting, whether that's to the TSX and ultimately to NASDAQ. These are all bigger ideas and plans that, in the background we look at because we really think these sorts of volumes, this sort of profitability will be recognized as time goes. And essentially, we're very excited to sort of build all of the awareness and liquidity elements out that we think will be very conducive to improving share price. There's another question here basically we're looking at how much of the company is institutionally owned. For perspective, I mean, EMERGE was a private company for about 4 years before we went public last year. We were a $9 million company at the time of go public. We're now a pro forma $60 million company, so we've grown it by 6x. Last time we raised capital at the beginning of this year in Q1, those rounds were approximately 50% institutional, 50% retail. Same with the RTO round. I would say the earlier crowd in EMERGE was a mix, but probably more on the retail side earlier. We're starting to see more institutional adoption, and the mix is approaching about 50-50. A third question, and I'll take this as the last question because we're almost out of time. Basically, how are you valued compared to e-commerce peers? And I did touch on this in the slide. The bottom line is, and this is really sort of the key takeaway, we're in the 1.5 times revenue range. We're in the 10 times pro forma EBITDA range. You're looking at vastly higher multiples applied at scale for some of these e-commerce companies, ranging from 30 to 70 times EBITDA and 20, 30 times revenue at the high end, and maybe 5 to 10 times on a more realistic basis. So I think for us, the punchline is scale matters, and we're starting to finally get it. EBITDA matters and is a big plus because many don't have it, but we do now. And we think that getting past that next acquisition that puts us north of 10 million in EBITDA, north of 100 million in revenue, I think that's going to be a major wake-up call. And I think any value investors looking at EMERGE now and looking at what we just accomplished in November with 10 million in revenue in sales rather in a single month, 1 million in a single day, these results in Q4 only get reported obviously in Q1. So this is the time to be looking at EMERGE and understanding what that detachment is about between us and between e-commerce companies, and whether you believe that's going to last. In our view, we believe that those two will converge. And I'll leave it at that, but I wanted to say thank you to everyone for tuning in. Thank you for the questions. Hopefully you found some value here, and if there's anything else you would like to follow up on, please feel free to reach out to investor@emerge-brands.com. We're really happy to take as many questions as you have. I'm actually seeing a couple of other questions come up. So please do feel free to reach out to investor@emerge-brands.com. We'll definitely address those and take our time with you all. Thank you so much.